Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
Today, we're sharing 5 stories. First, Foxconn, the company that builds iPhones for Apple, revealed its biggest business is now AI servers for clients like NVIDIA, with revenue set to explode by 170%. Second, data center developer Equinix is betting on nuclear energy to power AI, signing deals with companies like Oklo to pre-order over 1 gigawatt of power from transportable microreactors. Third, while Tesla sales crater across Europe, they've soared 24% in Norway. But the aggressive zero-interest deals are crushing the company's profit margins down to just 16%. Fourth, with the crypto market passing $4.2 trillion, companies like Circle and Peter Thiel-backed Bullish are rushing to Wall Street with IPOs, as Standard Chartered predicts Bitcoin could hit $200,000. And fifth, Amazon just sent Instacart's stock plummeting over 12% by launching free same-day grocery delivery for Prime members on any order over $25. The company that builds your iPhone just revealed a secret. The iPhone is no longer its biggest business. For the first time ever, Foxconn, the world's largest electronics manufacturer, announced that its AI server business is now its #1 source of revenue. Sales of AI hardware made up 41% of its income, officially overtaking its famous smart consumer electronics division, which came in at 35%. Now, this shift is more profound than it sounds. Building iPhones is a game of massive volume, but notoriously thin profit margins. AI servers, on the other hand, are high-value, high-margin products. So the thing is, Foxconn is fundamentally changing its business model. It's moving from a low-margin assembler for one dominant customer, Apple, to a high-margin technology partner for a whole new set of giants in the AI space. This gives them more independence and much greater pricing power. This is a seismic shift. The company, formerly known as Hon Hai Precision Industry, built its empire on the back of Apple. Now, it's becoming a key partner to the new king of tech, NVIDIA, manufacturing the powerful server racks that fuel the global AI gold rush. And to appreciate what a huge leap this is, you have to look inside those factories. Building these AI servers is a completely different ballgame from assembling a smartphone. We're not just talking about snapping components together. These server racks, especially for a client like NVIDIA, are an incredible engineering challenge. You have to manage the immense heat generated by hundreds of powerful GPUs packed tightly together, which often requires advanced liquid cooling solutions. You also have to handle massive power density and engineer high-speed connections that allow data to move between all those chips with almost zero delay. Foxconn has had to develop entirely new expertise to conquer these challenges. So much so that one of its AI server factories was named a global lighthouse factory by the World Economic Forum for its advanced manufacturing. And the financial implications are staggering. Believe it or not, Foxconn is forecasting that its AI server revenue will explode by over 170% year over year in the next quarter alone. Operating profit is already up 27%, crushing expectations. However, if you zoom out, you'll see another layer of strategy at play. This isn't just a business pivot, it's a high-stakes geopolitical chess move. With the threat of US tariffs looming, Foxconn is already moving its iPhone production for the American market to India. This is a classic de-risking strategy. By diversifying production away from its massive bases in China, Foxconn is trying to insulate itself and its clients from the trade war crossfire. At the same time, it's investing $1 billion in the US and striking new partnerships to build AI data centers and even electric vehicles. The company that once simply assembled our favorite gadgets is now diversifying at lightning speed, navigating global trade disputes, and placing massive bets on the future of technology, from AI to EVs to semiconductors. And these aren't just empty words. To break into the electric vehicle market, for instance, Foxconn has created an open source platform aiming to become the go-to manufacturing partner for a new generation of car companies. For semiconductors, it's forming strategic joint ventures to build new fabrication plants from the ground up. This isn't just a company changing its business, it's a sign the entire global tech landscape is being redrawn. The question is, who will be left holding the power? We were just talking about the hardware boom fueling the AI gold rush, but all that computing power creates an insatiable thirst for energy. That brings us to a radical new solution, powering the AI revolution with nuclear reactors. A major data center developer, Equinix, just went on the record with a bombshell announcement. They've signed multiple deals to power their operations with advanced nuclear energy. This isn't a small experiment. We're talking about a commitment for more than 1 gigawatt of electricity. To give you a sense of scale, 1 gigawatt is 1 billion watts. That's enough to power roughly 750,000 homes. So Equinix is essentially pre-ordering the output of a full-scale traditional nuclear power plant, but for its data centers alone, the context here is the voracious energy demand from the AI race. A single data center site can require the same amount of electricity as an entire city, and the world's power grids are already feeling the strain. So Equinix is making a radical move. They're planning to buy 500 megawatts of power from a company called Oklo, which builds next-generation fission powerhouses. This is where the situation takes a more complex turn. They've also placed a pre-order for 20 transportable microreactors from Radiant Nuclear. Yes, transportable nuclear reactors. What's often overlooked in these technical announcements is the community aspect. We're talking about placing these power sources near existing data centers, which are often in suburban or semi-urban areas. This brings up what some are calling the nuclear neighbor dilemma. There are serious logistical and security questions. Nuclear regulators have strict rules about how close reactors can be to populated areas, and public acceptance is a huge hurdle. Are communities ready to have a microreactor down the street? That's a question that hasn't been answered yet. And this isn't just happening in the US. Equinix is striking similar deals in Europe with developers like ULC Energy and Stellaria. An executive at Equinix made it clear this isn't a quick fix solution, but a core part of their long-term planning. And he's right, because here's the catch. While AI's energy needs are exploding right now, these advanced nuclear technologies are still years away from reality. The reality, however, is that even with a streamlined process, companies like Oklo face a 5 to 10 year timeline just to get their first reactors built and approved. So we have this massive mismatch, an immediate vertical spike in energy demand, and a solution that won't be ready for nearly a decade. While these advanced nuclear technologies aren't even commercially available yet, big tech is already placing its bets and signing the checks. This is a high-risk, high-reward strategy. Equinix is signing what are called pre-commercial power purchase agreements. They are locking in a price for power from technology that doesn't exist at scale yet. If these nuclear startups succeed, Equinix looks like a genius. But if they fail to deliver on time or at all, the company is exposed. This intense corporate demand is putting immense pressure on regulators. The US Department of Energy is fast-tracking programs to get new test reactors operating in less than a year. In fact, the department has created a pilot program that could allow test reactors to be authorized directly, bypassing parts of the traditional lengthy Nuclear Regulatory Commission licensing process. The concern here is whether the urgent need for power for AI could lead to accelerated approvals for unproven reactor designs, raising new questions about safety and oversight. The race to power artificial intelligence is officially on, and the new front line isn't in silicon, it's in the atom. The question is no longer if big tech will need more power, but what kind of world they're willing to build to get it. Speaking of high-risk strategies, another tech giant is navigating some serious turbulence. While Tesla sales are plummeting across Europe by as much as half, in one country they're not just surviving, they're soaring. As drivers in Germany, Sweden, and Denmark ditch the brand over what's being called Tesla shame, sales in Norway just jumped a staggering 24% in the first half of the year. So what's going on? The answer is a deep 12-year relationship. As one expert put it, in many ways, you could say Norway helped build Tesla. The company built its first European supercharger network there, locking in customers and creating unshakable brand loyalty. For years, this network was its ultimate advantage, its moat. It was extensive, reliable, and exclusive. But that advantage is shrinking. Competitors like Ionity, a joint venture by major automakers, are aggressively building out their own networks, and the whole industry is moving toward a universal standard called CCS. This means that soon, charging anywhere will be easy for everyone, and Tesla's exclusive club won't be so exclusive anymore. One new owner admits that buying one now is a double-edged sword, but says when it comes to the technology, no one comes even close. Delving into that double-edged sword comment, research shows that Norwegian consumers are incredibly skilled at separating the product from the personality of the CEO. In one survey, 40% of Norwegian Tesla owners said they believe Elon Musk's political activism actually harms the brand, but over half of them still plan to buy another Tesla. For them, the advanced tech and the car's performance simply outweigh the controversy. Here's where it gets interesting though, that dominance is now under serious attack. Volkswagen temporarily seized the top spot, Volvo is winning over drivers, and Chinese manufacturers have already grabbed over 12% of the market. And they aren't just competing on price, it's the technology they're bringing that's a real threat. Chinese brands like NIO are introducing incredible features like battery swapping stations that can give you a full charge in about 3 minutes. Others, like Xpeng, are putting advanced LiDAR sensor technology, the kind used for autonomous driving, into mass-produced cars. It's a full-on tech assault. So how did Tesla fight back? With a promotional blitz so aggressive, it triggered a 213% spike in new registrations in a single month. The company offered zero-interest financing, a deal won by called practically free money. You know, this kind of promotion comes at a huge cost. Offering free money has a direct impact on Tesla's bottom line. The company's gross profit margin recently fell to its lowest point in years, shrinking to just over 16%. This is a classic business dilemma. Do you sacrifice your profits to keep your spot at the top? For now, Tesla's answer seems to be yes. The question is, can this loyalty survive the controversy? The answer may come from a man who was once on the board of the Norwegian Tesla Owners Club. After watching the company, he came to a shocking conclusion. His new motto is now a direct challenge to the brand he once championed. To save Tesla, we need to boycott Tesla. This isn't just an emotional plea, it's a specific economic strategy. The idea is that if enough dedicated fans stop buying new cars and instead flood the used market, it sends a powerful message to the company's leadership by hitting their new sales numbers, forcing them to listen without completely abandoning the brand. That last story highlights the outsized influence of tech personalities. And speaking of which, another major figure from that world, Peter Thiel, is backing a new gold rush. The global crypto market just rocketed past a record $4.2 trillion. That's trillion with a T. After years of being on the outside looking in, crypto companies are stampeding to Wall Street. It's a complete 180 from the crypto winter of 2022, when the collapse of FTX crushed the entire industry. A huge part of this turnaround actually has been a major shift in the political climate. The previous administration favoured much stricter rules, but the current one has aggressively pushed for deregulation, aiming to make the US a global hub for digital assets. This created the perfect storm for a comeback. The bellwether for this frenzy is a company called Circle. It went public with an IPO price of just $31 a share. Today, those shares are trading for over $150. Its valuation has skyrocketed to around $35 billion. An analyst at Renaissance Capital called Circle's debut the biggest green light for the industry, adding that positive trading and a friendly regulator make for a powerful combo. Now, get this. That friendly regulator refers to the Landmark Genius Act, a new framework for stablecoins that has fueled the rally. This act provides the regulatory clarity the industry has been begging for. It mandates that stablecoins must be backed one-to-one by high-quality liquid assets like US dollars or short-term government treasuries. This isn't just a rule, it's a massive confidence booster for big institutional investors who were previously too nervous to jump in. It basically tells Wall Street that these digital dollars are safe and sound, which is a game changer. And now the floodgates are open. Crypto exchange Bullish, which counts billionaire Peter Thiel among its backers, just raised over $1.1 billion in its own IPO. When you see names like Peter Thiel, one of the original Web2 titans from the PayPal era, investing this heavily, it's more than just a bet. It signals a strategic move by established tech leaders to shape the future of finance. They aren't just riding the wave, they're building the infrastructure for the next version of the internet, potentially bridging the gap between old school Silicon Valley and the new world of decentralized tech. Other major players like BitGo, Grayscale and Gemini are already in line with their own confidential filings to go public. As one expert at IPOX put it, these are no longer purely speculative businesses. This quote gets to the heart of what's changing. For years, one of the biggest headaches for public companies was how to account for crypto on their books. But what's finally making this possible are new accounting rules that let companies report their crypto holdings at fair market value. This means their balance sheets can now reflect the actual gains from their crypto investments, making them look much more attractive and stable to traditional investors. It essentially legitimizes holding Bitcoin as a corporate asset, moving it from a wild gamble to a strategic part of the treasury. So where does it all go from here? The momentum is so strong that some are making staggering predictions. Standard Chartered now expects Bitcoin, the world's largest cryptocurrency, to climb and end the year at $200,000. From the rush to digitize finance, we now turn to how the digital world is waging war on the physical one, specifically in the grocery aisle. A single announcement from Amazon just sent a rival stock plummeting over 12%. The grocery wars have officially gone nuclear. Amazon just declared it will now deliver perishable foods like milk, meat, and strawberries on the same day for free to its massive base of Prime members on any order over $25. This isn't just a new feature, it's a direct shot at competitors like Instacart and Walmart Plus. Now, delivering a book is one thing. Delivering milk and frozen dinners alongside that book in the same truck on the same day is a logistical nightmare. It's what the industry calls cold chain logistics, and it is incredibly difficult and expensive. To pull this off, Amazon has re-engineered its entire delivery network. They are using advanced AI-powered routing algorithms to ensure that the ice cream in your order doesn't melt while also getting your new headphones to you on time. This involves specialized insulated packaging and even exploring multi-temperature delivery vehicles. This isn't just adding a new item to the store, it's a fundamental change to the physics of their delivery system. The market reaction was immediate and brutal. Instacart shares cratered by 12.4%, but the damage didn't stop there. DoorDash dropped nearly 5%, Kroger fell over 4%, and even retail giant Walmart saw its stock dip more than 2%. Wall Street's reaction stems from the brutal economics at play. This free delivery is almost certainly a loss leader for Amazon on a per-order basis. The cost of that cold chain logistics is immense, but Amazon can afford to subsidize these losses with profits from its other massive businesses, like cloud computing. It's an aggressive strategy designed to reshape the entire grocery market by making it impossible for less diversified competitors to keep up. So what's the killer detail that has the industry so spooked? One analyst put it bluntly, by lowering the order minimum to just $25, Amazon is directly threatening Instacart's core business model, which relies on customers making quick one-off purchases. This is all about what some are calling the everything cart endgame. By allowing you to buy low-profit, high-frequency items like milk and eggs in the same checkout as high-profit items like electronics, Amazon creates a powerful competitive advantage. Specialists like Instacart can't sell you a TV, and traditional grocers can't efficiently deliver one. Amazon can do both in one box on the same day. This integration creates a convenience moat that is incredibly difficult for anyone else to cross. And if you think this is a small test, you're wrong. The service is already live in over 1,000 US cities, and Amazon plans to expand it to 2,300 cities by the end of the year. The CEO of Worldwide Amazon Stores laid out the vision, stating that shoppers can now order milk alongside electronics, check out with one cart, and have everything delivered to their doorstep within hours. And this isn't just about selling food, it's about data. Groceries are bought frequently, creating a constant stream of information about our habits. This data is a gold mine for Amazon's other businesses, fueling its hyper-targeted advertising platform, which already generated over $56 billion last year, and informing which products to create for its own Amazon Basics private label. This move is backed by a colossal $4 billion investment to expand its delivery network into more rural communities. This decision brings both obvious benefits and comes with inherent risks. Research from the Brookings Institution shows that 90% of people in food deserts already have access to a delivery service, so this expansion could be a lifeline. However, other studies show that when e-commerce fulfillment centers arrive, local retail sales drop and workers' wages decline. The major concern is whether this convenience will come at the cost of killing off the independent local grocers, who are often the backbone of these same communities. This all begs the question, in the intensifying grocery wars, how can anyone compete with a company willing to spend billions to deliver milk and microchips to your door in a matter of hours?
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.